Have you ever wondered what separates a company that's truly successful from one that's just busy? Well, today we're pulling back the curtain on the one number that makes all the difference. It's called the cost of capital, and it's this hidden benchmark that tells you if a company is actually creating wealth or just burning through cash.
So get this. A while back, the big consulting firm Bain& Company did a deep dive on 71 of South Korea's top companies, looking at a whole decade of performance. And their finding was, honestly, pretty shocking. Out of all those companies, only four, just four, were actually creating real sustainable value. That's just 6%. A tiny, tiny fraction. A finding like that really makes you stop and think, doesn't it? It forces you to ask what it really means for a business to be successful.
So, what was their secret? What did those four companies know that the other 67 just weren't getting? It wasn't about having the flashiest products or the biggest sales numbers. Nope. The secret was that they understood a fundamental rule of finance. Every single dollar has a price. That's right. Every dollar or yen or euro that a company uses to run its business and to grow, well, it's not free. It comes with a price tag. And understanding that price tag is the biggest clue to solving this whole mystery. So here's the official definition. When a company gets money to operate, whether it's a loan from a bank or an investment from shareholders, those investors, they expect something in return, right? They're not just giving it away. That expected return is essentially the company's cost of capital.
I love this analogy. Just think about it. You rent an apartment, you gotta pay the landlord every month. Well, when a company rents money from investors, it has to earn enough profit to pay them back plus some extra. If it can't even cover that basic rent, it's already losing the game. Now, you're going to hear a bunch of different names for this idea out in the wild. Don't let the jargon trip you up. Required rate of return, hurdle rate, cutoff rate, they all point to the exact same thing. It's the minimum score a company has to beat. It's the bar it has to clear. It's the ultimate hurdle. So, to figure out a company's total cost, we first have to see where the money is coming from. And generally speaking, it comes in two main flavors. Okay, so the two flavors are debt and equity. Debt is what you'd think. It's money borrowed from banks or bondholders. You got to pay it back with interest. Then you have equity. This is money from the owners, the shareholders. They're not expecting interest payments, they're expecting a piece of the profits. Now, because lenders get paid back first if things go south, their risk is lower. And because their risk is lower, debt is almost always the cheaper way for a company to get cash. But wait, there's another massive reason why debt is cheaper. It has a kind of superpower that equity doesn't, and it's built right into our tax system. It's called the tax shield. Here's how that works, and it's pretty clever. The interest a company pays on its loans counts as a business expense, just like paying salaries or the electricity bill. That means the company gets to subtract that interest cost before it calculates how much tax it owes. A lower taxable income means a smaller tax bill. Simple as that. Equity investors, on the other hand, get paid from profits after taxes have already been taken out, so no tax break there. All right, so we know that companies use a mix of money, some cheaper debt, and some more expensive equity. Now let's put those two pieces together to find that single, all-important number that solves our mystery. Which brings us to the next logical question, right? If you have two different costs, how do you figure out your one single benchmark? A company can't have two different hurdles. It needs one number that reflects its entire financial recipe. And here's our answer. It's called the weighted average cost of capital, or WACC for short. And you know what? It's pretty much exactly what it sounds like. It's just a blended average of the cost of all the different kinds of money a company uses, weighted by how much of each it has. This one number, this percentage, is the company's true all-in cost of doing business. It's the definitive hurdle rate. Any new project, any acquisition, any big strategy, to be worth doing, it has to promise a return that is higher than the company's WACC, period. Now, the actual formula can look a little intimidating, but the concept behind it is as simple as making a smoothie. First, you figure out the cost of your ingredients, your debt, and your equity. Second, you figure out your recipe, how much of each are you using. And finally, you just blend them all together to get your final average cost. That's WACC. Okay, so we figured out what the cost of capital is, and we know its final score is called the WACC. Now, let's circle all the way back to that mystery we started with and see exactly why this number is the key to everything. Let's go back to those 4 superstar companies. What made them so special wasn't just that they got bigger, it was how they got bigger. See, they understood that not all growth is good growth.
The Bain study had 3 big tests for success. Yeah, you had to grow your sales and your profits by more than 5.5% a year. That's impressive on its own. But that wasn't enough. The third and the absolute most critical test, the one that only those 4 companies passed, was that the return on investment had to be higher than their cost of capital. They had to clear the hurdle.
And this right here is the biggest takeaway of all. A company can grow its sales by, say, 20%, but if it cost them 10% to get the money for that growth and they only earned back 8%, they actually lost. They've literally destroyed value for their shareholders. Growth without clearing that WACC hurdle is just a fast way to go broke.
This isn't just some abstract financial theory. It's an incredibly powerful tool for you, for anyone who's interested in business or investing. It gives you a brand new, smarter question to ask. From now on, look past the big, flashy headlines about record sales. Instead, try to find 2 numbers, the company's return on its investments and its WACC. If that return is higher than the WACC, congratulations, that company is creating value. If it's lower, well, it's destroying value, no matter what the glossy annual report says.
So now you're in on the secret. Growth for the sake of growth is a trap. The real, true measure of success is whether that growth is actually profitable. And profitable has a very specific meaning, earning a return that's higher than your total cost of money. That's the hurdle. And now you know to ask if they cleared it.